Hello, this is Simon Thompson, Vice President and Wealth Advisor at Texas Legacy Wealth Management. Welcome to our annual review and outlook for 2016. Today, we're going to briefly review the market's performance in 2015 and discuss our stock market outlook for 2016. A negative December for the S&P 500 brought with it an end to a choppy 2015 and a bleak year across many asset classes. The year ended with fairly flat returns for the S&P 500 with increased volatility in the back half of the year. In comparing the S&P 500 to developed foreign and emerging markets, the U.S. market outperformed for U.S. dollar investors while commodities and precious metals slumped. The 10-year U.S. Treasury also had a fairly flat year with barely positive returns. Performance in foreign markets improves if we look at returns in their own currency due to the relative strength of the U.S. dollar. Last year, a few factors overshadowed the rest in terms of stock market impact. Low oil prices, the aforementioned strong dollar, global economic weakness, and central bank policies. We've been talking about these issues throughout 2015 and believe they will continue to be relevant in 2016. In the U.S., the Federal Reserve finally bit the bullet and raised rates in December of 2015. While the financial press has spilled much ink over this topic, it's for good reason. Many investors are reluctant to fight the Fed and feel that an initial rate hike could signal the beginning of the end of Fed-fueled economic growth. We disagree with this sentiment and believe the path and pace of rate hikes throughout 2016 to be far more important than the first hike. In fact, getting the initial rate hike behind us may provide the market some much needed certainty and redirects the focus back on the fundamentals of economic growth and corporate earnings. The tightening in the U.S. may differ from approaches that other major central banks take, as we expect to see central banks in Europe, Japan, and potentially China ease further. In our opinion, commitment from central banks around the world combined with attractive valuations justifies international equity exposure. You can't tell the story of the global economy or stock market for 2015 without talking about oil. Oil prices have dropped sharply over the last 18 months, from roughly $100 a barrel in 2014 all the way down to the mid-30s in December 2015. Energy prices have impacted all corners of the financial markets, from corporate earnings in both energy and non-energy sectors, the high-yield debt market, CapEx spending, and the consumer. Global demand has remained in growth mode, but hasn't been able to keep pace with the sharp boost in supply. As we move to 2016, the question is, when will supply and demand reach equilibrium? We believe that until we see excess supply worked off, it's unlikely that oil prices rally in a meaningful way. One potential cure is the drop in exploration seen by the shrinking U.S. rig count, which through December 12, 2015 is down 62.5% year over year, according to the Baker Hughes U.S. rig count. This could be a case of low prices curing low prices, as many producers simply can't be profitable at current levels. We will be watching energy trends carefully throughout 2016, as a move in prices could have far-reaching consequences for the local and global economy. In 2016, the presidential election will dominate the headlines as a new president will be elected. Stock market returns during presidential election years have been normal on average and don't provide a strong indicator as to whether we'll have a better or worse than average year. We'll keep a close eye on the rhetoric during the election cycle, as the potential for legislative change can impact certain sectors. The healthcare sector was a recent example. Many presidential candidates and lawmakers focused on drug pricing, which led to uncertainty in the healthcare sector, particularly in pharmaceutical and biotech stocks. What drives the market's value? In the simplest terms, investors need to determine how much they're willing to pay for each dollar of a company's earnings. This can be measured using the PE ratio, price divided by earnings. As we look to 2016, earnings growth for the S&P 500 is projected at 8.1% per FactSet. This projected growth comes after a year of stagnant earnings growth. 2015 is projected to see an earnings decline of about 0.5%. This is attributed mostly to the strength of the US dollar and the weakness in the energy sector. If the headwinds felt from those factors ease, we believe we could see earnings growth resume. Valuations are above their long-term averages, and we don't see a strong case for valuations to climb substantially higher during 2016. However, we feel that today's PE of approximately 17.5 can be justified in light of the low interest rate environment. We often refer to our economic dashboard, which gives us a snapshot of economic conditions to help us determine if we'll see a recession in the near term. 3 of our 6 dashboard elements tell us that we need to be cautious, while the other 3 elements give us the green light. This mixed message bears close watching, but we feel we're likely in the later stages of the current economic cycle, not on the cusp of recession. The lack of a pending recession leads us into 2016 fully invested and cautiously optimistic for positive stock market returns. For more information about Texas Legacy Wealth Management, you can contact us via phone, email, or feel free to visit our website. We'd also like to remind you to follow us on Twitter and like us on Facebook. Thank you.